talk portfolio positioning. For more on how to position your portfolio amid the markets, we're joined by Marcus Bogdan from Blackmore Capital in Melbourne. Look, Marcus, you're there right in the hotspot of Melbourne at the moment. What's your take on just how concerning this is? I mean, obviously concerning for the community. It's horrific. But in terms of markets more broadly, are you concerned about the increase of cases and the now 6-week lockdown and how that might actually impact markets?
Good morning, Ingrid and Daniel. Yes, absolutely. We saw it in the United States where half the population there's been a reversal or a pause in reopenings. And now you're seeing it in the second largest city in Australia, being Melbourne, and all of those things. We had very good news, economic news in June. We had a very sharp recovery in PMIs there, and we also saw analysts net revising upwards for the first time in 2 years. Now, what we're seeing in the US and now what we're seeing in Melbourne gives a sense that momentum will potentially stall, and so that is definitely a concern, and it definitely lends itself to particular stocks and weightings in the portfolio.
So just how much are you going to look to change those weightings at this point in time? What are you looking at that's attractive? What's most at risk with everything that we see, everything that we know?
Sure. Well, we're certainly going to stay away from sort of that L-shaped type of company, where those ones which are affected by social distancing. I think the banks will continue to be under pressure, and we've seen the cuts there in dividends, particularly in Westpac, NAB, and ANZ. What we like is being pretty consistent. We came into this crisis where we're already seeing a slowdown in earnings in the Australian domestic economy, and so we really wanted to be positioned in higher quality, more resilient type of companies, and so that lends yourself to consumer staples, the defensive industrials, Amcor, Cleanaway, Brambles, healthcare. I think it's important to see in this lockdown that elective surgery hasn't been stopped in Victoria, so we still like healthcare primarily through CSL, Helios, and Ramsay, and telecommunications I think will still continue to do well also. I think you can still have some cyclicality in the portfolios, but we're playing that through a recovery that we're seeing in China, particularly around construction and infrastructure spending. And so both BHP and Rio are well supported in the portfolio in that way as well.
Marcus, do you think the worst is yet to come? I mean, we've got reporting season obviously coming up as we're sort of discussing, and yes, that will give us an idea of how businesses are responding or have been impacted by COVID. But with another 6-week lockdown hitting Victoria and potentially more to come around Australia, we're uncertain of how this is going to track. I guess going forward, the reporting season after that could be a bit of a lag effect from what we're seeing. I mean, how long do you expect the impacts to play out for when it comes to a company perspective?
Well, I don't think we're going to get back to a full recovery in terms of the recovery in earnings for the market. I mean, the earnings for the market peaked in September 2019 at around $110 billion. And we don't think we're going to get back to that previous peak until well into FY22. So it's a 2 to 3 year turnaround there to see that full normality and the full capacity coming back into the economy. And so that's why we want to stay with companies, stay with those winners that I think will have a much more muted effect on their earnings, and they'll continue to still generate revenue and earnings and pay dividends to shareholders.
Is that specifically applying to the miners in this case? You did mention BHP and Rio, but you also mentioned stocks like Amcor, Brambles, real staples, bellwethers of the economy. Do you think these ones will have no trouble paying dividends when we come to 2021?
Those, I think if you look at Coles, if you look at Wesfarmers, you look at Woolworths, I think those dividends will certainly be well supported. In healthcare, you did have the contraction there. So I don't think those dividends will really start to be paid until FY 2021. CSL, I think, will still be able to maintain both growth and a dividend there. And the telcos have reconfirmed their guidance, whether it be Spark, New Zealand or Telstra. And then specific REITs, I think around Waypoint, which in previous weeks we've talked about here, where I think a 5.5% yield is maintainable, and companies that are in that industrial logistics space benefiting from online growth, such as Goodman, will also be able to pay a dividend going forward.
Obviously an entirely different sector, Marcus. This Afterpay placement that's taken place, Tencent, one of these major strategic investors in the 20s, has now come back effectively looking for more. When you're looking at stocks that are looking to grow, that potentially one day might pay a dividend, do you see that buy now, pay later space meeting that criteria, or is it just simply too speculative in your opinion?
No, I mean, we're not invested in that space. Originally, we were concerned about sort of the ability of wholesale funding, and we saw that sector, particularly in the global financial crisis, come under a fair degree of pressure there. Our preference in terms of technology is around subscription businesses such as Xero or Nearmap, where we think there is strong recurring earnings and a very substantial marketplace that they can capture.
All right, Marcus, we might leave it there with you, but we really appreciate your time on the program. Thank you for joining us.
Pleasure. Thank you.